Hi, my name is Mahesh and I'm from Select Trades. We'll be discussing about technical analysis of the stock over here. When we talk about analysis, there are two types of analysis. One is fundamental analysis and another is technical analysis. Fundamental analysis include the overall economy, the overall industry, and the company. When we talk about analysis of the company, it's the analysis of the financials of the company, the profit and loss and balance sheet of the company. I mean, how sales is growing, whether profitability is commensurately growing, what are the different ratios, what is ROE, what is ROCE, what is DER, what is the promoter's percentage, what the percentage of this is pledged to the bank, etc. But today's topic is technical analysis. So let's talk about technical analysis. Now, technical analysis and fundamental analysis, are they completely exclusive? Can they coexist? Yes, they can coexist. In fact, when I talk about technical analysis, I apply technical analysis on the stocks which are, for which fundamental analysis is already done. So these are, two things which are overlapping over each other, and we need to be there on the overlapped portion. Now, technical analysis is nothing but forecasting of stocks future price basis the past trend of the price over a period of time. Now, there are different tools which can be applied to predict this future price. But after all, it's prediction. There is no 100% guarantee that stock will behave in the same way. When we talk about technical analysis, the starting thing is demand and supply. I mean, why a price of a stock increases or decreases? Simple demand and supply equation. If the supply is higher, demand is less, the stock price will go down. And if the demand is higher, supply is less, stock price will go high. When demand and supply are both are equal, the stock price will remain as it is. And this point is called as equilibrium price, uh, which is as shown pictorially here. But this is ideal situation. This never happens. So demand and supply force the prices to go up or go down. Same demand and supply equation can be used to explain support and resistance on the charts. Look at the chart. Now here, the red line which shows in the upper chart is working as a support for this particular stock. At this price, there are no sellers available. So, there is the huge demand and the price will not come down below a certain level. If it comes down to a certain level, there are buyers available which will grab the stock, and again the price will go high. So this level works as a support level where the price generally will not go down than this. Exactly opposite is resistance. When there are no buyers and there are a huge number of sellers, the price of a stock will not cross a certain barrier. Even if it try to cross that, there will be sellers available which will push the price back down. So this line works as a resistance for this particular stock. Needless to say that resistance will be above the stock price and support will be below the stock price in the chart. The primary thing in technical analysis is understanding different charts. Though there are n number of charts types, we'll be discussing only four types over here, which is shown pictorially. Now, in the picture, I have shown four types of the same company at the same time so that you can understand the difference between them. The first is line chart. Now, line chart I prefer just to understand the retracement level, just to understand crossing of resistance and support level. Bar chart is equally popular in trader community as such. But the most important and most popular is the candlestick chart. This is widely accepted because of its inherent advantages of the look. Just by looking at the chart, you can understand whether the stock is in uptrend or it's sideways or downtrend. And then there is a fourth one, which is point and figure chart, which is a little complex and it is used in currency trading. So let's understand how candles are formed in a candlestick chart. Uh, in the picture, there are shown two candles. One is green candle, and on the right side there is a red candle. Now this candle time frame can be from 1 minute to 1 year. Let's talk about a daily candle. Now, why this candle? The bulky portion of the candle, it's called as body of the candle, and the line-like structure at the top and at the bottom, it's called as wick or shadow of the candle. The upper portion is called as upper shadow, and lower one is called as lower shadow. Now, why left candle is green? Because the stock price starts at a low price, it moves up, it makes a daily high, again comes down to a lower price, and then settles at a price which is higher than the opening price. So the closing price of the day is higher than the open price. That's the reason the candle is green, showing it's an uptrend. Exactly opposite is the right candle. The stock starts at higher price, move higher, again comes down, makes a daily low, and closes at a point which is lesser than the opening price. So closing price of the day is lesser than the opening price, showing that the stock is in downtrend, uh, and that's the reason this candle is red. Having understood the candlestick of a chart, let's understand the range of a chart. There are two ranges. Is in fact one is called as trading range and another is called as trending range. Now look at the chart of Hindustan Aeronautics Limited, which is shown there. The portion in the bracket is kind of the price is oscillating between the upper portion and lower portion of that rectangle. The difference between upper portion and lower portion should be less than 10% ideally. So stock is spending time here oscillating between these two boundaries. This is called as trading range. Once the stock breaks this rectangle, either moves up or moves down strongly, then it's called as trending range. As shown, it's moving up strongly. That's an up trending range. It can move down as well, which will be down trending. So this is how trading and trending range of a stock defined. This is introductory first part of technical analysis, which has touched upon some basic things like candlestick. In the second part, we will be talking about the patterns of the candlesticks and the strategies which can be used and the trends, how those can be identified basis the chart. Do follow me. Thank you very much.